I'm Fred McClymans of Samadhi Partners Equity Research, and on today's newsletter brief, we are counting down our top 10 2017 tech acquisition picks for 2017. Joining me today is John Freeman and Gwilyn Arnick, partners at Samadhi Partners as well. Gentlemen, welcome.
Thanks, Fred. How you doing?
Doing well. So here we are. It's the end of the year. It's the 29th of December. We're cutting it right to the very edge. We have compiled our top 10 tech acquisition picks, companies that we may or may not have an interest in our side company, Samadhi Capital Partners portfolio. But I do want to let everybody know that this is an informational newsletter. We're not making any stock recommendations. We're not making any stock picks, and we're not making or offering any type of solicited or unsolicited investment advice. So, with a grain of salt, gentlemen, let's kind of take a moment before we get into this list. What are you expecting out of 2017 in terms of a general theme in the investment space? I mean, this is something that we've talked about a bit, and I think from my perspective at least, I'm expecting a little bit less of the moonshot type activity and a little bit more of the operational, predictable, less risk type of M&A activity moving forward. So, John?
Yeah, I would probably agree with that. And I think, there might be some of that macro risk on going into 2017. Obviously, Trump is very much of a wild card. So if there is sort of a big macro dislocation and where, sort of all of the babies get thrown out with the bathwater, their bathwaters, then a smart corporate M&A department could move in and might be able to snag outstanding assets, for a discount that really is going to probably, get washed out by, 2018. If, like I said, that's assuming that there is some 2017 macro dislocation.
Well, I think we're likely entering into a higher interest rate environment, which historically has not produced outstanding stock returns. I would also expect the M&A momentum to continue into 2017. 2016 was a very an inquisitive kind of environment for a lot of the software companies that we follow. Yeah. I would expect that to continue.
There were some deals. There were 3 picks from our portfolio in 2016 that were actually acquired this year. So we can sit back and go nicely done for that. It was nice to see that activity there. And those were
the one that surprised, the one that sticks with me that was a big surprise. It was a large weight. It was a Samadhi 4 weight in the portfolio. Was ARM Holdings, because ARM, had been rumored to be acquired by at various times, Apple, Qualcomm, Intel, but ARM's independence as a licensor of chip intellectual property kind of creates a value. The value of theirs is independence, and yet they got acquired. The conglomerate SoftBank, and probably the only kind of pure investment kind of acquisition was going to happen, actually did happen. And the guy who runs SoftBank is just a very, very savvy investor, has made excellent investments over time. But there was no synergy between ARM and SoftBank. It was just a great, in my opinion, it was just a great play. And of course it benefited us. So
I think a bit about SoftBank the way I do about some of the larger global PE firms. I mean, SoftBank is into a lot of different things, and for them, it's not necessarily synergy as much as it is access into a particular marketplace or a piece of technology that they really want to own,
or just great returns, or with great duration, which is honestly what ARM really did offer. As an independent company.
Yeah. So the other 2 firms that were acquired were Infoblox, that was Vista Equity that snapped them up, and InvenSense, TDK, my favorite tape deck manufacturer.
That was a surprise for me. I didn't even know TDK was in that world, but yeah, the core competence to build accelerometers and these kinds of MEMS-based technologies is really limited. There's not that kind of core competence all around the world. It's not like Java programmers or anything like that. So, and it's obviously a key key, element in any of the drone technologies, driverless cars, robots, go on and on and on. There's a lot of applications for those kinds of micro gyroscopes and micro accelerometers. So,
what I found interesting in 2016 was the amount of acquisitions that came from private equity.
Yeah,
I think that's just purely a function of a lot of these private equity firms raising numerous funds throughout the last couple of years and having a lot of cash, dry powder per se, and they were very aggressive about going out and buying some companies with strong cash flows and low debt.
Is part of that also a bit of pullback on the part of the publicly traded companies? Not necessarily being quite as aggressive and giving an opening, or do you think this is really a situation where some of the PE firms took properties off the table that, some of the other, some of the likely, vendor, companies out there that we would have expected to be interested were simply just outbid?
Well, I think in 2016, you saw a lot of the larger public companies, specifically the software companies, very much interested in a lot of the deal flow. I think that some of the private equity purchases were just a function of these guys having a lot of, like I said, cash available, and a lot of the valuations, in my mind, they were a little bit stretched. Some of the acquisition prices paid were a little bit stretched, but it speaks to the environment that we're in.
I would agree with that. I think with Infoblox and some of the other ones too, maybe Cvent as well, there's situations where the value of those companies, let's say Infoblox, for example, is a hardened DNS, domain name server, appliance. That's not the sexiest, most high profile sort of security play, and yet they are. I saw their value. I thought they were a key a part of the cybersecurity ecosystem, and somebody else did too, I suppose. But at the end of the day, it's not one of those solutions that's highly synergistic with anybody else. So the private equity firm could really kind of realize its value, I suppose, over time. But I would say that, and maybe Cvent is another one. That's a local company here in Tyson's Corner, McLean, Virginia. That it was kind of not criticized, but just derided a little bit for having sort of a transactional model where the value of SaaS is, that perpetual, payment, the ongoing revenue stream, the predictable revenue stream. Whereas because of its transactional, but I don't think that really. I think that really kind of sold short, if you will, the real value of Cvent. I mean, there's not very many. They kind of had almost a corner on the market for event planning by corporations, and they're the one-stop shop for kind of event planning and event coordination. It's a great marketplace to be in. It doesn't matter whether it's transactional or not. Every corporation is going to have these kinds of events. It's going to need their service. So,
and I got to tell you, ACV, or the annual contract value. I mean, I've lived that, in a company before, yes, and it can be a great thing if you can leverage it. It's absolutely phenomenal. It's such a predictable revenue stream coming in,
right?
Of course, the downside there is that for many years, just like in SaaS, companies really didn't know how to value ACV. It wasn't quite the same model that they were used to. But I think we've crossed that hurdle.